You've been with the same bank for years, maybe 8 years, maybe 12. You pay your bills on time, you keep a decent balance, you've never caused them a single problem. And last month, a stranger walked in off the street. No history, no relationship, no loyalty whatsoever. They got a better rate than you, a lower fee, a sign-on bonus, and a banker who actually picked up the phone. You got nothing. Not even a, hey, we appreciate you. Look, that's not a mistake. That's not an oversight. That is exactly how the system is designed to work. And by the end of this, you'll understand why. And more importantly, you'll know exactly what to do about it. My name is Ricky, and I spend way too much time thinking about the gap between what banks promise and what they actually deliver to the people who stay. Genuinely, my family has strong opinions about this habit of mine. But here's why it matters. If you're someone who does the right things financially, pays on time, keeps your accounts in good standing, and still feels like the system isn't really working in your favor, you are not imagining it. Here's the number that should reframe everything we're about to talk about. A 2022 consumer finance study found that existing bank customers pay, on average, interest rates that are 0.2 to zero point 0.5 percentage points higher than brand new customers on the exact same products. Same loan type, same bank, worse deal for you. On a $300,000 mortgage, that gap is somewhere between $15,000 and $30,000 over the life of the loan. Quietly taken from you because you stayed. The banking industry actually has a name for this. They call it customer inertia, which is a very polite way of saying they are counting on you not leaving. If this is already making you think differently about your bank, hit that subscribe button and give this a thumbs up because we're just getting started. Now, before we go any further, I want you to think about where you actually sit in your relationship with your bank. Because the way this loyalty penalty shows up depends entirely on how deep that relationship goes, and it looks very different depending on which version of the story you're in. So, let's start at the beginning. The person who just has the basic accounts. This is most people. This is probably you. You have a checking account, maybe a savings account connected to it. You use your debit card. Your paycheck hits every 2 weeks. You keep somewhere between a few hundred and a few $1,000s in there at any given time. The bank's official promise to you is simple: safety, convenience. Your money is there when you need it. And look, they deliver on that. That part is real. But here's what they quietly leave out. The average big bank checking account pays 0.01% interest on your balance. 0.01%. If you have $2,000 sitting in that account right now, you are earning 20 cents a year. 20 cents. Meanwhile, that same bank is lending your deposits out at 7, 8, 9, sometimes 20% on credit cards and personal loans. They borrow your money at 0.01%. They lend it back out at 20%. Take a second with that math. Now, here's exactly where the new customer gap shows up. When someone new walks through the door, banks offer promotional rates, 4 or 5% on a new savings account for the first 6 to 12 months, a $300 cash bonus for opening a checking account and setting up direct deposit, waived monthly fees for the first year. You know what the existing customer gets when that new customer's promo eventually expires? Nothing changes for you. You were never in the promo to begin with. Let me make this concrete. You and your neighbor both have $5,000 in savings accounts at the same bank. Your neighbor opened their account last month. They're earning 4.5% as a welcome rate. You've had your account for 7 years. You're earning 0.01%. After 1 year, your neighbor made $225 in interest. You made 50 cents. Same bank, same balance, same year. 50 cents versus $225. That is not a small difference. That is the bank charging you for your loyalty without ever sending you a bill. And here's what makes this worse. Banks know you probably won't leave. Switching banks sounds simple until you actually think about it. You have to update your direct deposit with your employer. You have to reroute every automatic payment, your gym, your streaming services, your insurance, your utilities. Every single recurring charge has to move. That list lives in the back of your mind, and the bank has already done the math on it. They know that list is long enough for most people to stay in place, even when they're frustrated, even when they know they're getting a worse deal. That friction has a name inside the industry: switching cost. And for the person with just the basic accounts, that switching cost is high enough that the bank has essentially decided your frustration won't reach the threshold that makes you walk. Impressive in a very uncomfortable way. And that's before you've borrowed a single dollar from them. Now, let's move to the next level: the person who actually borrows from their bank. The customer with a car loan, a personal loan, or a mortgage at the same institution where they've kept their accounts for years. This is where the loyalty penalty stops being annoying and starts being genuinely expensive. Because this person did everything that felt right. They built a relationship, they kept their accounts clean, and when it came time to borrow money, they went to their own bank first. The place they knew them, the place they trusted. That feels like the smart move, right? Well, here's what actually happens. Banks don't price your loan based on loyalty. They price it based on your risk profile and how badly they need to win your business. A new customer walking in, the bank wants that relationship. They'll sharpen the pencil. They'll offer a competitive rate to close the deal. You're already there. You already said yes to them years ago. They don't need to compete for a customer they already have. So they don't. A 2023 report from the Consumer Finance Protection Bureau found that borrowers who stayed with their existing bank for refinancing consistently paid higher rates than borrowers who shopped around. The loyal customer paid more every time. Here is the number that should stop you cold. On a 30-year, $350,000 mortgage, a difference of just 0.5% in your interest rate costs you $37,000 over the life of that loan. $37,000. Not because your credit is bad, not because you're a risky borrower, because you trusted your bank to treat you fairly. Now, here's the psychological piece, and this is important. When you've banked somewhere for years, something shifts in how you think about that institution. You start to feel like the relationship means something beyond just transactions. But the banker across the desk is not thinking about your 9-year history when they enter your rate into the system. They're thinking about margin. They're thinking about what the pricing model allows. Your loyalty is not a line item in their pricing model. Nobody really says that out loud. One more thing about borrowers specifically. Banks advertise loyalty rate discounts. You've probably seen them. Existing customers receive 0.25% off their loan rate. Sounds like a reward. But if a new customer is already being offered a rate that's 0.5% lower than yours as a starting point, and then you get 0.25% off, you are still paying more. The discount is real. The loyalty reward is a reframe.
They handed you a coupon for a store where new customers already pay less than you do. All right, now the third version of this story. The person who has everything at one bank. Checking, savings, mortgage, car loan, credit card, maybe a small business account on top of that. This is the customer banks put in their marketing materials, the relationship they publicly celebrate. You're a platinum member. You have a dedicated relationship manager. We value customers like you. And this customer is, statistically, the most overcharged and under-rewarded segment in all of retail banking. But here's where it gets genuinely different from everything we've talked about so far. It's not just about rates anymore. At this level, the real weapon the bank has against you is something called fee creep, and most people have never noticed it happening to them. Here's how it works. When you first opened your accounts, you probably had some benefits included: a waived monthly maintenance fee, a promotional savings rate, free wire transfers, no charge for paper statements. Those benefits have expiration dates. Sometimes the bank sends a notice. Usually it's buried inside a terms update email that looks exactly like spam. And if you don't catch it, you just start paying. Not because you agreed to pay more, because you stopped paying attention. And the bank is absolutely not going to call you to say, hey, your free benefit expired. Want us to restore it? That call does not exist. Now here's what makes fee creep the most sophisticated version of this whole problem. The bank doesn't need to raise your rate dramatically to extract more money from you. They just need to quietly remove enough small benefits over enough years, $20 a month here, $15 a month there. Over 10 years, that's $4,200 in fees you probably didn't notice leaving your account. Quietly, consistently, on top of the rate gap, on top of the promo cap. And because everything is consolidated under one roof, leaving feels almost unthinkable. Not impossible, just genuinely disruptive to your entire financial life. Here's the thing about that disruption. The bank engineered it deliberately. Every additional product you bring over increases how painful it would be to leave. Every product is another reason you stay put, even when the deal gets worse. And once you see that clearly, something shifts. Because the same system that was designed to trap you actually has a very simple weakness. Once you understand the mechanism, disrupting it doesn't require dramatic moves or starting over from scratch. It requires a few specific actions, done on a schedule. We're going to get there in just a minute. But first, I want to zoom out. Because everything we've covered sounds like individual bank decisions, a few bad policies at a few large institutions. It's bigger than that. This is a structural feature of how retail banking works in America, and it does not affect everyone equally. Here's what the data shows. Black and Hispanic households are more likely to consolidate their primary banking relationship at a single institution, partly due to historical exclusion from multiple financial systems, partly because of community trust patterns, partly because of access and geography. And because of that consolidation, they are more exposed to exactly the dynamics we've been talking about. Higher effective rates, less promotional access, fewer rate negotiations, more fee exposure over time. A 2021 study found that Black homeowners refinanced at measurably lower rates than white homeowners during the 2020 low-rate environment, not because of credit score differences, but because of access to information, access to competing offers, and the confidence that shopping around was even a real option for them. That's not just a personal finance problem. That is a generational wealth problem. And this plays out across every demographic, just unevenly. Here's the 40-year picture. The average American household will spend roughly 40 years as an active bank customer before retirement. During those 40 years, they'll carry at least one mortgage, multiple car loans, revolving credit at savings accounts throughout. If that household consistently pays even 0.3% more across their borrowing products, because they didn't shop around, because they believed loyalty would be rewarded, because the friction was just high enough to keep them in place. Across a mortgage, 2 car loans, and ongoing credit card balances over 4 decades, the cumulative cost of that loyalty penalty lands somewhere between $40,000 and $90,000, depending on your balances and rates over time. That is not a rounding error. That is a car. That is a college semester. That is a down payment on a home for the next generation. Real money, leaving your household quietly, in amounts too small to feel on any given Tuesday, but enormous when you finally add them up. And here's why this is so psychologically hard to fight. The pain is never acute. Nobody calls you to say, "We just took $40 from you this month because you're a loyal customer." It happens in the spread, in the rate you didn't negotiate, in the promo you never received, in the fee that quietly appeared in month 14 after your welcome benefit expired. Chronic, quiet financial loss is the hardest kind to address because you never have one clear moment where you say, "That's enough." You just slowly pay more than you should, for years. But here's what changes once you see the mechanism clearly. The fix is not complicated. You don't need to become a financial expert. You don't need to blow up your entire banking relationship. You just need to do two things and do them on a schedule. Two things, that's it. Because two things you'll actually remember and do are worth more than 10 things you won't. First, renegotiate on a schedule, not when you're frustrated, on a calendar. Every 12 months, call your bank and ask one direct question. What rate are you currently offering new customers on this product? Then ask them to match it. You don't have to be aggressive. You don't have to threaten to leave. You just have to ask. Banks have retention desks. They have rate adjustment tools. They have the ability to give you a better deal. They just don't do it unless you ask. Most people never ask. And that phone call, made calmly once a year, can recover thousands of dollars over a decade. Second, use external competition as leverage. Before your next mortgage, car loan, or refinance, get a real rate quote from a competing bank or credit union, then bring it to your current bank. Say exactly this: "I've been here for 9 years. I just received this offer from another institution. I'd like to stay, but I need you to come close to this." That sentence, said without drama, works more often than most people expect. Because the moment your bank knows you have somewhere else to go, that's really it. The loyalty penalty only works on customers who act like they have no options. The moment you act like someone with options, even a little, the entire dynamic shifts. Here's what I want you to carry out of this. Your loyalty to your bank is genuinely worth something. Banks know that. They measure it. They build entire business models around capturing it and holding on to it. The problem is, they're not paying you for it. They're keeping it. And the only way to change that is to make sure your bank understands, clearly, that your loyalty has a price, and that price is a fair deal. You're not asking for special treatment. You're asking not to be penalized for staying. Drop in the comments how long you've been with your bank and whether you've ever actually called to renegotiate a rate. I want to know how many of you have tried it and what happened. Because that conversation right there in the comments is where something real starts. Not in dramatic moves, not in complicated strategies, in the quiet phone call you make on a Thursday afternoon. I'm Ricky. I'll see you in the next one.